Hello, everyone. I hope everyone have had a good lunch. Very warm welcome and thanks for joining us this afternoon. I am Big Shan, Managing Director, Capital Markets at CapBridge. For those of you who are not yet familiar with CapBridge, we are a MAS licensed and SGX-backed global investment syndication platform for private opportunities. Our group also runs the One Exchange, which is Singapore's first regulated blockchain-enabled private market exchange where companies seek private listings for partial liquidity while retaining control. Together, CapBridge and One Exchange form a holistic private markets ecosystem in Singapore, the region, and globally. Today, we are very honored to have with us Mr. John Sharp, Managing Partner of Singapore headquartered Hatcher Plus, which is a next generation data-driven global venture firm, to talk about a topic which I personally find very interesting, and that is Venture Capital 3.0. So what exactly is VC 3.0? How is it disrupting venture capital investing? When did this trend started? Where are we now? And what can we expect to see in the future? Without further ado, let me invite John to the stage now. Hey, John. I'm so glad to have you with us today.
It's great to be here. It's great to be finally on stage together.
You're looking great and your background is looking great as well.
Thank you.
Well, you know, I've personally been around the private equity and venture investing industry for some 10 to 20 years by now, and been through some of the most traditional ways, things are being done in deal selection,
Sure.
Due diligence, investment decision, the really old school stuff we all know, right? So I read that Gartner has said that by 2025, and that is no more than 5 years from now, more than 75% of venture capital and early stage investors' executive reviews will be informed using artificial intelligence and data analytics. And there will be no more so-called gut feel in selecting deals. Well, there's many buzzwords there, but this certainly looks like a great leap forward for the industry. Yeah. Now tell us more about it.
Yeah, I was really pleased when I saw that Gartner stat come out, because that jives very well with what we're seeing and hearing on the ground. And what's fascinating about it is when you look at when you try and do AI well, you come up against a very large number, and that very large number is the amount that you need to invest in doing it well. And so what we find fascinating about that figure, about 2025, is there's obviously some quite well-capitalized VC funds out there in the world, but there's a very, very few that we've come across that are actually investing significant amounts of money in AI. So we think that there's quite an opportunity here for people that have done that. We've invested $10 million so far in building out our data models and our technology platform. So it's and I think, as you know, we license this for free to any VC that wants to use it. So we think we're actually in a very good position. If the Gartner report is true, and in 4 years we do see this transition happen, then we're going to be in a very nice position, I think, as one of the leaders in this space, to be able to provide those kind of services and data modeling and information to traditional VCs. But maybe I should share a little bit about how
yourself, tell us about yourself, and what does your team at Hatcher do?
Yeah, well, maybe if you don't mind, maybe I'll share some slides with you, and we can show some folks on the call what we're up to. Can you see my screen okay there?
Yes.
Brilliant. Okay, so we're talking today about VC 3.0. So what is VC 3.0? We basically see this as kind of the third iteration of the VC model. The first being the creation of the VC model in roughly 1960 back in the Valley, when ARDC invested in Digital Equipment Corp and created a 1000x return, 100% IRR. That really set the world on fire and made people very aware of the venture model for the first time. Then you had Sequoia and NEA and a bunch of other folks that came along in the 70s. and 80s, and so Silicon Valley grew, but at the same time, the rest of the world was taking notice. And VC 2.0 was really about the sort of global reiteration of the Silicon Valley model. And so now what you see around the world, you see, it doesn't matter whether it's Singapore, London, KL, Manila, Sydney, Los Angeles, it's the iteration of the Silicon Valley model. And largely that's been happening over the last 20 to 30 years. But what hasn't really been happening is the evolution of the kind of technology evolution that you've seen happen in Goldman Sachs over the last 30 years, that you've seen happening in public equity trading and other asset classes generally. And so where we saw a gap in the market was for the evolution of a VC 3.0 model, which is a model that's basically looks for global opportunities, but uses a massive amount of data, machine learning, and technology, or largely automation. I mean, the old sort of saying in machine learning is once you get a sufficient amount of models built, then you have to turn to automation to execute. I think it's interesting at this point to point out the fact that that we actually, at one point in time, we were a traditional VC model. We had a first a holdco structure here in Singapore. It was more of an accelerator model, sort of an ideation model. It's been quite successful, and we've returned about 22% IRR up to this point. We've had 4 exits, 2 on the public markets, about to do 1 more in the next couple of weeks, which we're very pleased about. And so people say, well, if your first fund, which is a traditional approach, was so successful, why are you now looking to adopt all this technology and sort of change your methodology to be more of a fintech, venture tech company? And the answer to that is quite simple, and that is that when we took a very hard look at our first fund and why it's been successful, I can sum it up in one word, and that is luck. We would like to think, like everyone else in the VC industry, that we're smart guys and that we're very connected and that we add value to companies. But the truth of the matter is that if you have a very small VC fund, you are enormously reliant on luck to get a return back to investors. And it doesn't matter really how hard you work. You really need to have a few lucky breaks for the fund to break above the break-even point. And so around the end of the first investment period for the first vehicle, we started doing some analysis, and really what we're trying to do there was to figure out what the odds were of success within the VC environment. And so we actually did a really deep dive. And when I say we, I'd like to introduce my partner here, Dan Hookturp. He can't be with us right now. He's sleeping. He's based in Florida, but Dan is one of the pioneers of AI and commercial data science. He's probably the most commercially successful data scientist in many ways in America. He was the guy who came up with the original models for Bankrate and took what was at the time a $30-something million company to a $500-something million company over 7 years in terms of revenues. IPO'd it very successfully. Very, very smart guy. And so Dan is the guy that built all the models behind the Hatcher Plus framework. In my own background was working in satellite content and infrastructure in the 90s here in Asia. And then I went and founded a cybersecurity company in the US, sold out of that, moved back to Singapore, started doing angel investing. And of course that ended up with our first investment vehicle, with which I had 49 investment partners. The great thing about working in the US during that time is I got to work with pretty much every major telco and every major technology company that was consumer facing. A lot of them used our technology. And so it was super interesting for me to get a handle on how those big companies think and work. We also have some fantastic advisors on our team. Sushi Taira, who former head of investment at SoftBank, Winnie Chen is director of AI at PwC, and Tony Morgan and Steve Fisher are our fund managers. So our fund is managed under contract by First Degree Global Asset Management. They're MAS licensed fund managers, fantastic guys. Anyone that's looking for very, very good managers in Singapore, we'd recommend them very, very highly. So getting back to the model and what we found that was different and what we think will be different about the VC 3.0 model, and to Big Shen's earlier point about the adoption of AI in venture, whenever you want to use AI, you have to first start with an enormous amount of data if you hope to get some useful outputs. We've done the largest research effort that we're aware of in the world on venture capital. We've analyzed over 600,000 transactions spanning over 20 years now of venture investment, and we've constructed about 4 billion virtual portfolios. And these portfolios are like 20 ad tech funds in London, 50 generalist funds in India, 2,000 generalist investments around the world. And we've tried to combine all different sectors, stages, and geographies in these portfolios to figure out what strategies work. And what we discovered from this, which I'm going to share with you very openly, what we discovered from this research now, because I think it's important to the understanding of the models that will follow and why Gardner is saying that AI will be adopted. So the first finding is that venture returns really don't follow a normal distribution curve. They follow power curve characteristics. What do I mean by a power curve? A power curve happens when you have 1 out of 100 companies that you invested in become a unicorn. A power curve happens when Coinbase gets set to IPO for $100 billion, 8% of which is owned by a $200 million fund, which is going to see a 40x return on the entire fund from one investment out of the fund. That's a power curve. A power curve is that 1 in 100 companies that just goes to the moon, returns the whole fund plus a multiple. And there's usually about 1 in every 100 seed stage investments. And we've looked at that fairly exhaustively and using empirical data from Y Combinator, 500 startups, Sequoia, just a lot of empirical data seems to back up this fact. The other piece of information that we found from surveying about 160 VC funds, most of whom are friends and people in the industry, is we found that typically a professional VC fund will select about 1 deal out of every 100 deals it sees. And so you'll notice, some of you that have read my blog will see that there's a blog in there where we talk about how unicorns are a 1 in 10,000 bet. And that's about right, because if you're selecting at the rate of 1 in 100, and then 1 in 100 of those selections are then going on to be a unicorn, that's where the 1 in 10,000 comes from. Now, I don't know if any of you have ever looked through 10,000 deals. We had 10,000 come through our platform last year. I'm very glad that I didn't have to go through them individually, because there's just no way that we would be able to do that in any kind of physical sense. It's just too much work. So now at the end of this year, our platform will see about 30,000 deals. So the investors on our platforms, the accelerators, the VCs, everyone that's on our platform will see in aggregate 30,000 deals. What we use the AI to do, and this is what Gardner's talking about as well, is to sort through those deals and figure out what's an exact match for a particular fund manager's mandate. And that's super helpful for the entrepreneur that's starting the company, and super helpful for the fund as well, because at that point you can all spend a lot more time with stuff that's important to, with groups that are important to both of you. So we've basically created this engine that enables us to look at a whole bunch of deals. And the reason we're doing that is because we've decided, based on this research, that it makes no sense to do what we did again. And we're not very in love with strategies that involve portfolios of less than 100 companies and even less than 500 companies. There's now some supporting research, the research that we've done, that came out from excellent folks at INSEAD and Google Ventures, also supported by Harvard Business Review. Institutional Investor published this last year, that shows that if you have a portfolio of less than 500 companies, you're not necessarily in the danger zone, but you're in the unpredictable return zone. Whereas if you have a portfolio of over 500 investments, you're just going to be able to create much more of a normalized curve around that. And to the point here, if you look at this chart on the right, any of you that have a decent sized portfolio will find this quite fascinating, I think, because in that little inset graph there, you can see that basically a 100 investment portfolio on average returns 2x, and a 2000 investment portfolio returns 4x. And you can say, well, how well supported is this finding? Well, it's supported by 4 billion simulations that we've done over 3 years. So this is why we've chosen to build a 2000 investment portfolio. Those 2000 investments will go into 1,350 companies. But as you can see, the midpoint on that blue line, which is our strategy, it returns 4.2x. And this is if we do nothing other than build a large portfolio. So we're chatting about this with a fund in the Middle East the other day, a fund of funds. And the guy said, I get it. He said, out here in the Middle East, we drill 100 oil wells, and we're hoping that the 100th one will be the one that really brings home all of our investment plus some. So it really is just a question of making sure that you're casting a very large net, drilling more oil wells, whatever the analogies you like to use. Logically, this does make a lot of sense, and it's nice to see that this is also backed up by the data models. By the way, this curve here says nothing about quality. We're not assuming when we make this graph that we're going to do a better job of selection or that our AI is going to play any kind of role at all. All we've done here is create data models based on historical data. And what that shows is if you build a larger portfolio, it shows that Dave McClure was right when he created 500 startups, in that actually is the point at which you can start to generate predictable returns. And he really has. The 500 startups has generated some great returns for its investors. The other thing that we looked at is we're kind of interested in where people make money in venture capital. And for those of you that have bought secondaries in Facebook or DoorDash or Airbnb, you've probably made a bit of money, but there's a whole bunch of Series D, E, F, G companies that you'll invest in that don't do as well. And so as you can see on this graph, towards the end of the graph here, where you see rounds 5, 6, 7, 8, that's those later series rounds. And you can see that the spread on the returns there is not that great. The red line is the NASDAQ IXIC, by the way. So that red line's NASDAQ index. And what you can see is that the first 4 rounds, which are formation, pre-seed, seed, and Series A, that's really the best place to put money. And people always ask when they see this graph, like, surely, you guys aren't accounting for failures and write-offs and things in this. We absolutely are. One of the most difficult things we found in 2 years of data modeling was cleaning up the data was one part, but also filling in the gaps, because no one ever puts out a press release when the company goes down or becomes a zombie. So we had to really dig to find information on what was going on at a lot of the companies that we were studying. So this graph absolutely accounts for the write-offs and failure rates. And you can see that even given those, you can make a ton of money in the earlier stages of formation round, seed round, Series A, my favorite rounds to invest in. And the only trick there is that you need to do a lot of investing. We've all of us angel guys have got 10 or 20 deals in our portfolio, and very few of those are actually going to be the ones that win. By the way, there's another very important data point to share here, and that is the data point that only 5% of post-seed stage companies return money, actual cash, to their investors. Again, that power curve effect of focusing in on 1,000 companies with the hope that you'll have 10 really great winners that will return cash either through an IPO or a trade sale. So there's a narrow window there for finding those multiples in venture. Venture 3.0 is really about understanding exactly what those odds are and building systems that can go out there, embrace those odds, and generate the returns that we know are there. So basically, what you've probably figured out listening to this by now is that if we're selecting 1 out of every 100 deals, and we want to build 1,000 company roughly portfolio, then we have to look at 130 or 100,000 deals. We actually have to look at 135,000 deals. So what we've done is we've gone around the world and we've offered our technology. We've got a really fabulous technology that we call the VAST platform, which stands for Venture as a Service Technology Platform. And we've offered that to a whole bunch of folks. You can see the guys that are using it there on the right-hand side here, all those blue dots. We see a lot of deals through those guys. With the guys on the left here, we've done co-investment deals with these guys where we've agreed to actually enable the funds that we work with to co-invest with them based on their ability to share deals with us via our platform. And that's working really great. So by the end of this year, we'll be seeing about 30,000 deals a year. We think that's roughly equivalent to around about a quarter of the startups that are going to enter the ecosystem any year. So over the course of the next few years, we want to grow that up to a point where we're seeing around half the world's startups. And at that point, things become super interesting because most of the investors that we meet with, they don't just want to invest through us through a fund. They maybe want to put a bit of money with us and use us as a feeder to find direct deals, and that we think is also going to be something going forward. So when one of the funds that works with us finds a deal, the assumption can be made that the investors in that fund will be also looking for deal flow from that fund. And the Economist did a bit of research on this a year ago and found out that it was a roughly 3-to-1 split, where family offices in particular wanted to invest most of their money direct and some of their money into a fund. And we found that that was basically a 25-75% ratio. Now that changes if you're meeting with a investment fund such as a pension fund or insurance company. It's very much a fund-driven model. But for individuals, particularly angels, we find that they're very much looking for funds to provide more of a feeder role so that they can co-invest with the fund. They can find great deals and use the fund's technology, smarts, connections, etc., to help bolster their own deal flow. So on that subject, we've built this really fantastic technology. We've spent millions of dollars building it. Most people give up after $1 million or $2 million. We were just the guys that were crazy enough to continue on the journey. The one benefit of COVID is that we had a chance to go back and completely refactor the platform, which we've done. So we're using everything in the platform now as 2020 technology. We've got 26 APIs, everyone from Twilio to Slack to you name it, Google, Crunchbase, CB Insights, PitchBook. So we really do a lot of integration with data vendors, but also a lot of integration with business automation, people that can help us automate processes. It's one of the things you have to automate when you're helping fund managers run funds that have 1,000 companies in them, is you've got to automate the audit, you've got to automate portfolio management, you've got to automate the deal flow and the sorting, the reporting, all of these things. And so our platform does that. And on the subject of investors looking for deals, you can go inside any of the funds on our platform and you can say, I want to search for something. And we had a group the other day that pushed up a request for carbon sequestration. We were able to find a whole bunch of folks in our database that fit that model. Recently, on behalf of a foundation, they were interested in disaster mitigation technologies. So we're able to find 87 matches, 15 at the stage that they wanted to invest in. So even in very niche areas, we've got this massive database of startups, most of whom have been raising in the last 2 years. And so you can go onto our platform as an investor and you can find a lot of deals, or as an investor in one of the funds that is using our platform, and you can find deals. For most of the funds that are on our platform, the managers of those funds will insist that you're first an investor before you get access to these kinds of technologies. What we're doing for the managers that we work with is we're also helping figure out which of the impact deals on the way in. This is a huge area of interest. I can't overemphasize enough how many people we speak with that are really super interested in impact. So what we do is we use our AI much again in the way that Gardner is foreseeing to figure out what about this particular company is impactful. Why should we focus on them and put impact dollars towards that? Another interesting trend in impact that we've seen a lot of, and I'm sure all of you have as well, is there's a lot of very, very smart commercial money that's focused on impact now. And what people are looking for is a return so that they can reinvest that money and continue to make an impact with that cash. So we're seeing now a lot more impact funds that are return driven, but also they're looking to not invest in greenwashing stuff or stuff that's pretending to be impact. They want the real deal. They want to find truly impactful companies. For the funds that use our technology, we've included a lot of process automation that we've built here. The process automation also enables a lot of functionality on behalf of the founders. Founders can use this to basically keep track of capital raises. They can use it to manage their cap table, to present profiles to people that may want to see them manage their teams. There's a lot of really great technology that we've built into the platform that people are using all around the world. It's available in 18 languages. We had someone call us up the other day and say, why don't you have Swahili as a language? So we added that over the course of a few days. And what we're trying to do now is build out the capability. We now have 50 currencies that we support on the platform as well. So for managers that are looking to onboard a lot of capability without having to spend a lot of money, then it's obviously a really great thing to do. And our managers that we work with on H2, of course, are using our platform, and that's one of the reasons that it will be able to scale to 1,300 companies. Finally, just a quick word on the platform capabilities here. A lot of what happens for investors when managers attempt to report is it's a very manual process. Nothing about what we're doing on the platform is manual, including the reporting. You can press a button on our platform, and for any fund that you're managing, whether it's one of our funds or someone else's, and that fund manager will be able to output a report instantaneously. LPs can usually output the report themselves when that's permitted by the manager. Finally, I just wanted to have a word here, because this is maybe linking it all back, Big Shen, to our conversation about what we're doing together. So we really love the Singapore structures that it's recently put into place. We think the VCC structure is just fantastically well thought through, brilliantly executed. We've been working recently with ACRA and with our fund managers as well to try and get that to a point where it's a really clean kind of ability to create structures. What we're looking to do here, again, is process automation. We're looking to create situations where it's very easy for investors to invest in a fund without a whole lot of friction, where they can apply to our fund managers, and the fund managers can put them into a fund on the VCC structure fairly quickly and very cost effectively. And by the way, one thing we've noticed about the VCC structure is it's quite a bit, it's significantly less expensive than the European equivalent, which we'd probably say is Luxembourg, and also less expensive than Cayman, and it's right here. So we really love this structure. Our platform, what we do is we try and pull together all the pieces here using technology. So what we're trying to do here is to make sure that the fund manager, the administrator, the auditor, and the private market participants all have access to the same data sets on an error-free basis using our process automation. So our vast platform sits below this and kind of holds together all of these parties. And that was our whole sort of intent when we created Hatcher Plus, is we wanted to create a situation where everyone could share high quality data, build high quality models, understand what's trending in the markets, and follow their own investment mandate, which is the most important thing, because everyone's got a slightly different investment mandate. So I just sign off by saying that up there, you can see in the top right-hand corner that we're plugging into capital markets. That's CapBridge and One Exchange. We're super happy to be working with you guys and looking forward to the launch on this, which I think is in the next couple of weeks, right? It's coming up pretty soon. So we're really looking forward to working with you and seeing how we can pull this together and make it even more VC 3.0 than what we're illustrating here today.
Right. John, thanks so much for the very insightful sharing, and thanks for giving CapBridge the opportunity as well, right? I really love your oil well analogy. I think, that is very apt. And I'm really impressed, by the list of the VCs, that you're already working with, and I see they're so global. Right, and I actually picked up that our very own A-Star is also using your platform.
They are, and that's been really good. We did a couple of showcases with them during COVID that were really valuable. We were just basically mind sharing around the COVID vaccine and therapy responses. But they use the platform internally. Also to manage things within the Accelerate part of A-Star. And I love A-Star. I used to work there many moons ago, so I have a very fond spot for A-Star as a group. And boy, they're really world-class. As an organization, we should all be very proud, I think, of what they've built here in Singapore. It's just a terrific group.
Right, thanks for the compliments. Right, so a couple of questions here. So your model is based on historical data, am I right? So
yeah,
how predictive, is this really, of a future returns?
Yeah, we would say it's very predictive. I mean, if you look at how AI is used around the world, we have to make predictions based on back-tested data. There's just no other way that you can make predictions. And what you'll see is that every single disclaimer that you can imagine, you can see them down the bottom here on this page, around, past results do not predict future returns. It's absolutely correct. Anything can happen in the future, but without an understanding of history and past results, it's impossible to make predictions. So the predictions that we're making are really, they're very basic predictions in the sense that the question, we expected to get some more sophisticated answers that we did, like more fine-edged answers, I guess. The answer that we got around portfolio size really just, it focuses on the fact that if you want to have a relatively less risky approach to venture, and that's the way that institutional investors characterize it, you just need to have a much bigger portfolio. If you have 1,000 company portfolio, you can comfortably expect to get 10 unicorns out of that portfolio. Now, you may get one, you may get 5. You'd have to be pretty unlucky statistically to only get 1 out of 1,000. We would question whether you'd done a good job on selection at that point, because statistically, that's the mid case. And if one of those happened to be Coinbase and was returning 40x your entire fund, well, at that point, you're in the absolute stratosphere. So can the back testing, can past results be helpful as a guide with respect to what happens in the future? I think everyone in the finance industry would say yes. I mean, even FICO scores, credit scoring, you've got to use some indicators before you give the guy a credit card. You've got to use some past history as an indicator. So I would say what we're doing here is really just adjusting the risk downward. We're trying to make it a safer place for people to be inside venture capital. And that was actually the theme of the institutional investor article. It was basically saying that VC is perceived as a risky asset class, but if you approach it the right way, it's really not any riskier than many other asset classes, and you can actually make quite a lot of money from it. So we would see all of the big data that we use to create our machine learning models to help us inform our strategy as very strong indicators. But what you'll notice that we're not saying is, at the same time that we're building these models, we're trying to improve our understanding of the quality that's coming through our deal flow. And so a lot of the technology and the trending analysis that we're doing now is an attempt to actually increase and improve the quality of the deal flow that each of our fund managers may be seeing. And so when we're licensing to a VC our technology, our expectation is that it's going to help them do a better job of sorting through what's coming through the door. So that our expectation is that may bias the returns, but in a positive way. So we don't see this technology necessarily doing any negative biasing. Actually, what we see it doing is positively biasing the results, if there's any bias at all. And there's actually a blog on my website where we talk about AI versus human reasoning in Hatcher, because we get the question a lot. Are you guys using only robots, or are you using humans? And I would emphasize that whenever we work with another manager or an accelerator, we're always leveraging their intelligence. We're always using their inputs to help us build these and aggregate these portfolios. So we're never doing this outside of human understanding and human intelligence. That still rules the roost. And even in 2025, the AI will be more of an assist. It'll be like a junior analyst in the room. And the senior partners will still be making the decisions, is still our prediction then. But hopefully they'll be making decisions based on a much larger portfolio after seeing this analysis.
Right. And speaking of quality, it's a huge amount of data that you are obtaining and monitoring on a regular basis. And as we all know, if it's a garbage in, it's garbage out, So how is this process, actually managed, within you?
Yeah, great question. So we've got dozens of people on our platform that send us deals. We've only qualified 20 people or 20 groups that using diligence to see what the quality is. They see if it's as an investable quality at that level. There's many groups that focus on job creation. There's so at the local town council level, you'll find accelerators, for example, that are all about how can we create something that'll work at this local level and create some jobs in the community. That's not the kind of thing that commercially we can invest in, but certainly they can use our technology. So what we're looking for constantly are accelerator partners, fund manager partners that have a demonstrated capacity for excellence. And as soon as we find those guys, we attempt to do deals with them so that we can leverage our technology to help them build portfolios and hopefully put some money in as investors.
Right. Okay. Just one more last question from me, and then we'll open up the floor to questions from the audience. Right. So, how long have your model been running, and how would you so-called quantify the success, of your model?
So again, so we had this idea around mid 2016. So we incorporated then. Dan came on board early 2017. We started building the models. It involved about 12 months worth of data cleanup. So we got our hands on a lot of data. It was super dirty. So we had to do a lot of cleanup on it. Then we started building the models. We did a small amount of investment in 2018, and then we did a proof of concept level of investment in 2019 of 100 companies. So now we have about 130 companies under management overall now, and we're just getting ready to start cranking that up to a point where we'll be making an investment a day, or our fund managers will be making an investment a day, hopefully within starting in the next few months. By the way, post-COVID, I've never seen such activity in our industry. Everyone is just raring to go, and they can't wait to get on with investment. I think we're all sick of sitting around and waiting for stuff to happen. Everyone's just ready to go in 2021. So we're seeing a lot of desire for increased activity from everyone we work with, from entrepreneurs to accelerators to VCs to managers to everybody.